Welcome everybody, Stephen Sitkowski here, leading educator on how to trade the financial markets and the founder of Sitkowski Wealth Academy. Anyway, I'm coming to you from snowy Utah today. As I look outside, you can tell I'm kind of bundled up. I'm getting ready to go out into the elements and meet an associate of mine. I hope wherever you are safe and warm and ready for the new year. So I thought I would do a couple of things for you. Let's sort of do a year in review and talk about what things look like for next year and how you might want to think about positioning yourself. Now keep in mind when I do this, it's for educational purposes only. I'm not trying to give you specific investment advice. Don't know a thing about your personal finances. I try to get people to think. I mean, thinking is a beautiful thing. And I want people to move out of autopilot and to become much more disciplined in their approach and take a real responsibility for their results in life. Speaking of which, made some notes for myself. Last year, you could have been a complete idiot and made a bunch of money in almost anything. So here are the numbers. Stock market went up last year a little better than 30%. Corporate bonds, 20%, high yield bonds. So these are higher risk, higher interest rate instruments. They went up 14%. Treasuries, backed by the full faith and credit of the U.S. government, were up 15%. Gold was up 16%. All right, so as we look ahead to 2020, let me just give you some of my thoughts. First of all, in 2018, we had a 20% pullback toward the end of the year. We didn't get any of that this year. So we're going to be going into 2020 with a head of steam. And what I've learned is nothing goes straight up forever. You know that, and I know that. So that is a bit cautionary. What does the market do after it just made 31 or 32%? It slows down, is the answer. Fourth quarter corporate profits on the S&P 500 was actually down 6%. And typically in the last quarter, we see corporate profits slowing by 10%. Might this be the reversal? And might we be going into a corporate profit recession in 2020? Not sure. We have a PE ratio right now of 24.3. That is the highest level it has been since the financial crisis. What does that mean? Stocks are expensive. They've been riding this momentum wave because of an accommodating Fed and because of the tax cuts that came out in 2017. And China is still the wild card. It's still sitting over here. We haven't solved it. We have a phase one hypothetical trade agreement with them, but nothing has been signed. And at any point in time, if that deal goes south, that would be problematic. What do we have in favor of the market? It's an election year. And typically, incumbent presidents, and especially this one, will do anything to keep the market propped up. They'll exert pressure on the Fed. They will use regulatory cuts, whatever it takes. A lot of rhetoric that'll be coming out of the White House. And by the way, it's not just Trump. Every president does it. Typically, in an election year, if it's a Republican, market goes up about 15%. If it's a Democrat, goes up about 7%. So that would be the upside. Plus, we have a very accommodative Fed that will look for any slowdown and try to bolster the market. So what I think is going to happen, I think the first half of next year is probably going to be fine, and then I think we're going to move into a period of very high volatility. So what do we do as investors? How do we reposition ourselves? So as you can see on the screen, I've pulled up a heat map that includes the 11 sectors from the S&P 500. So what do I think might be successful? Well, as we look at these, I think technology is certainly driving our world. You have software and hardware. On the software side, the leader is Microsoft. You have Oracle, Adobe. On the hardware side, Apple, Intel. are both going to be probably pretty strong for the year, everything else being equal. Financial services normally rely on higher interest rates. This is bank and insurance. I don't think we're going to get those. As the economy slows down, I don't see the Fed raising interest rates for probably another 12 months or so. So financial services doesn't get me very excited. Excuse me. Consumer cyclicals, you have Amazon, Home Depot. I like the concept of Amazon conceptually. Their stock hasn't been doing great, but when things get tough, and I think things are going to get tougher, people look for value. Amazon is certainly a play. Industrials, I don't want to be in if the economy starts to slow down. Healthcare, are people still going to buy drugs? Yeah. So you have Johnson & Johnson, Merck being the big leaders. Doesn't mean they're going to be the best companies. It just means they're dominant in that space in terms of market cap. And then you have some medical device companies, which are smaller, like Abbott Labs and Medtronic. Communications, are people still going to be using Google on the interactive media side and Facebook? I would dare say so. Consumer defense is normally a good place to put money. This represents companies where people are just going to have to buy basic goods and services. So Procter & Gamble, Walmart, again, pretty defensive names. Energy stocks, we've got energy prices that have rebounded this year. Barrel of oil is now at 62. Are they going to run much higher? It depends, right? We've got, again, more conflict in the Middle East. So drilling companies, refineries, they should do pretty well. Most of the oil and gas companies pay a nice big fat dividend, 4 or 5%. You're going to want to have some exposure there. The REITs, if interest rates go down, they should do well. Again, it's a place to get a nice dividend, and in that 4 to 5% range. Utilities, are people going to still pay the utility bills? They are, obviously. So you may want to check NextEra. Energy, Duke Energy is another big one. Southern Company, another major player. And then basic materials, that would probably slow down. So again, technology, believe in. Healthcare, believe in. Communication services, Facebook, Google. Consumer defense, little bit in real estate investment trusts, and some utilities. So if you want to be more defensive in your overall positioning, that would be where I would take a look. All right, if you have not subscribed, become a subscriber. Click on the notification bell every time I produce something new. You will get notified. And I hope that you have an amazing New Year's Eve. Stay safe. Don't do anything dumb. I want to have you with me next year. Remember, it's all the amateurs that are out there driving on New Year's Eve, right? They're not the professional drinkers. It's people that tie one on a couple of times a year. Just like with your portfolio, be defensive. Till next time, God bless, and look forward to talking to you right after the new year. Bye for now.